Hey, this is John Crypto. Get ready, because what you're going to see isn't volatility. It's a billion-dollar trap that was made to look like it was happening. At the start of 2025, an ounce of silver was worth less than $30. Then, in just one day, it went up to $121 an ounce and then back down to 64 shares an ounce. Yes, you read that right. It dropped 57 kilos in just a few hours. And when the mainstream media screamed silver bubble bursts, retail traders burned. What do you think? Retail traders kept putting $430 million into SLV ETFs during the chaos, including $100 million on January 30th alone, which was the biggest one-day drop in silver history. The headlines are not true, and here's the kicker. They want you to think that this disaster happened because people were shopping too much, which is a warning about greedy investors chasing hype. But what is real? Retail is a trap, and the real sharks are swimming just below the surface. What about the panic? Planned chaos. Now that you have all the pieces, the truth is hard to take. A lot of what you see on price charts isn't real liquidity. ETFs like SLV, paper futures, and swaps make it seem like there is more silver than there really is. They make up a shadow market that is much bigger than the real silver market. What are the vaults at COMEX? Lows for a number of years. Shanghai, prices are $5 to $7 more per ounce than they are in New York. The price of physical silver is too high for the market to keep up with, and institutions aren't just watching. They're quietly buying every ounce. And as stores rush to meet margin calls, the system is flooded with forced liquidations. When people panic and sell, it makes the market look like it's crashing, which adds to the stories on social media about crash and burned investors. At the same time, smart money is trading ETFs for real silver at prices lower than what it is worth, quietly taking billions of paper contracts off the market. Picture a robbery happening in slow motion, with stores unknowingly paying for the vault raids. Volume analysis tells a much worse story. Prices are going down, but open interest is going up. This is a common sign of bullish accumulation hiding as panic. Take a closer look. The difference between spot and futures prices is a clear sign of demand in the East. The Shanghai premiums are going up, but the COMEX futures are going down. The difference of $5 to $7 isn't just numbers. It's a sign that the East is quietly buying up silver while the West panics on paper. Retail traders are stuck in a mental cycle. Every time the price goes down, you want to buy, and every time it goes up, you feel like you're missing out. They come in with a lot of power, but they don't know that the margin call hammer is waiting for them. The system is designed to steal all of their money. Whales and banks, on the other hand, are moving behind LLCs, ETFs, and hidden vaults and stacking up offline. Every time you panic, you're helping someone else get richer. You might not know this, but the volatility you're seeing isn't normal. This isn't just a ride on a roller coaster. It's the start of a historic structural pressure. In the real world, silver is going away. Open interest and futures tell one story, but real vaults tell a different one. Prices are keeping the West busy, but buyers in the East are quietly building up their positions. This could make the next move very bad for retail traders who aren't ready. And it gets worse. The news won't tell you that you can trade paper contracts for real metal for a small fraction of their real value. That means that every time you panic and sell your stocks, you are giving money to the people who will own the next rally. This isn't trading, it's organizing. Are you just following the red and green candles, or are you really seeing the supply drain happen right in front of you? COMEX stocks are falling, Shanghai premiums are rising, and real silver is leaving vaults faster than any ETF can copy. The stage is set. The trap is ready. What about the whales? Retail is going blind. They're going to flip the board. Do you think this change in price is normal? Change your mind. Just wait until you see how quickly real silver is disappearing and who is secretly buying it before the West even knows what's going on. The next move isn't coming. It's being made in secret, and it will change the silver market forever. Next, you'll learn who is taking advantage of the West, how paper derivatives are being used as weapons, and why every fear you see is someone else's paycheck. The bleeding silver markets aren't just numbers on a screen. They're being set up, The COMEX and London vaults are emptying so quickly that any casual investor would be scared. 20–30% of the silver that was available has already been sold this year, hitting multi-year lows. At the same time, Shanghai prices are $5 to $7 per ounce higher than New York prices, which is a clear sign that the East is quietly hoarding. Retail traders see red candles and screaming headlines, but they don't realize that every panic is someone else's payday. Silver in real life is moving faster than futures can keep up with. The big news is that the price of paper silver has gone up to more than 3 times the price of real silver. ETFs, futures, and swaps make up most of the market, so it seems like there is a lot of money available. When prices go down, forced liquidations come in like a tidal wave. On red days, retail traders get stuck, margin calls pile up, and fear spreads. In the meantime, the real players are quietly stacking and trading paper for real silver at a price that is only a small part of its true value. Now, put the pieces together. The villain's playbook is a book. BlackRock, JP Morgan, and other companies are secretly buying silver and using the market's instability to their advantage. The Fed's dovish signals have kept yields low and leverage cheap, which has let these big companies grow without anyone noticing. Every time you sell in a panic when the candle is red, you give them another ounce. And don't forget how bait and switch works. Silver crash is what the headlines say to scare people and get them to sell their stores. At the same time, smart money is selling ETFs, which takes real silver off the market at prices lower than what it's worth. It's a quiet but ruthless transfer of wealth. Stores are closing, and institutions are getting ready for the next step. You can't ignore echoes from the past. During the 2008 financial crisis, banks secretly bought more gold and silver, which shocked and overleveraged retail stores. The same thing happened in 2020 with the FTX-style panic. Chaos made worse by leverage kills people who don't know what they're doing, while whales make money and move to new positions. History doesn't repeat, it rhymes perfectly. But this is what sets it apart. The East is quietly piling up, while the West is bleeding. The story behind Shanghai premiums and Asian ETF inflows isn't one that your local news will cover. US inventories are getting smaller, and retailers are holding on to every downturn. At the same time, big positions are quietly building up offshore where no one can see them. People are putting real silver into private vaults, and paper contracts can't keep up with the real silver that is being stored behind closed doors. The leverage trap, the vault drain, and the bait and switch headlines are all part of the same planned action. Retail panic is the fuel, forced liquidations are the engine, and institutional accumulation is the goal. If you've been looking at price charts and thought this is merely market volatility, you should think twice. This is a war for silver, and stores are getting involved without even knowing it. And it's getting worse and worse. The West is losing money and its stockpiles are getting smaller. The East, on the other hand, is quietly building up its wealth through a mix of ETFs, physical purchases, and central bank purchases. This isn't just a guess, it's a big picture strategy at work. Different policies, incentives, and geopolitical positions are coming together to make the next big change possible. Next, you'll learn how the East-West divide is making a ticking time bomb, why Shanghai premiums are a sign of trouble, and which unknown people are quietly changing the global silver supply chain. And when the West is hurt, the East eats. In the US, SLV ETF inflows are just a small part of what is going on across the Pacific. The Shanghai Futures Exchange is losing physical silver at a rate that makes New York vaults gasp. The premiums are $5 to $7 per ounce higher than the NY spot price. This means that demand from outside the US is using up silver faster than the US can supply it. People aren't talking about the real buyers, though. Whales are quietly gathering and moving huge amounts of physical silver into private vaults, where they hide behind LLCs, shell companies, and ETF wrappers. Central banks, whose names are not known but whose positions are becoming clearer, are secretly adding silver to their holdings to protect themselves against a dollar that is losing its grip on global dominance. Now put the pieces together. This hidden buildup is caused by changes in policy. People in the US are hearing rumors about tariffs, mining restrictions, and export controls that make things seem scarce. Asian countries are also making it easier to bring in goods and giving people reasons to stack them up. There is a quiet war going on between the East and West, and every change in policy either lowers or raises the world's supply. Costs of mining are also rising. It's hard to make things because of energy, labor, and ESG rules. As a result, industrial and investment demand is much higher than actual production. The Shanghai premium isn't just a number, it's a bright red light that says the physical market is tighter than it looks on paper. What's the real story? Silver is no longer just a good thing. In a growing macro war, it's a reserve hedge. East gets the money, West prints it, and stores are left to fight over bits of paper contracts. Every ounce that goes east is a block in a fortification against the dollar's decline, a subtle uprising against its power. And what is the secret sauce? Arbitrage. When physical silver goes overseas, ETF inflows follow. This makes it look like volatility when it's really controlled accumulation that looks like chaos. Retail sees the red candles and margin calls, but the people behind the scenes are changing the rules without anyone knowing. History shows us that the more East hoards, the more West prints. Asian premiums go up every time US stocks go down. When SLV ETFs go down, it's a sign for offshore whales to buy more. And every time retail fear happens, it makes the giants pile bigger. The difference between the East and the West isn't just a trend, it's a time bomb for prices. And here's a hint about what's coming next. This planned squeeze from East to West is making things worse. When there isn't enough silver and global debt is rising, along with cheap leverage and rising inflation, silver could go up to levels that will shock retail traders who aren't stacked. The next part will talk about why macro doom is unavoidable, how the Fed's printing trap makes this happen faster, and why people who still have paper instead of real money could be completely left behind. The time is running out, and the stage is set. When the East-West silver war is at its worst, no one will be safe because of retail ignorance, and this is where everything comes together. The US debt clock is going crazy at $38 trillion. Japan's government bonds have negative yields, and the amount of debt in the world is growing too quickly. Every day that goes by, paper assets become a trap for people who still believe in banks and ETFs. At the same time, precious metals slowly become the safest place to keep your money. But the Fed is stuck in its own game. Because of aggressive liquidity injections and very low yields, real returns are going down all over the place. That's why stacking silver is no longer an option. It's something you have to do. Every time there is a forced liquidation, a red day in the ETFs, or a panic headline, the smart money gets more of what they want. The Fed might not raise rates again if inflation rises, which would give precious metals more time to do well. Now put the pieces together. The system doesn't work. ETFs, leverage, and central banks messing with supply while retail chases viral hype. It's a recipe for disaster. If you bet on short-term spikes without knowing how East-West flows work or how to deal with physical shortages, you could lose everything. In just the last year, margin calls, liquidations, and fake liquidity have already hurt a lot of retail traders. If East-West accumulation keeps up and supply stays tight, a rally caused by physical demand could raise the price of silver to $150–180 per ounce in the next 6 to 12 months. But it won't be easy to get there. Expect big moves, big pullbacks, and headlines that try to scare you, while the big players quietly buy up silver in person. What do you need to do now? Don't listen to the hype and the panic. Focus on accumulation zones, which means getting real silver, keeping it safe, and stacking it in a way that is organized. They can't change, erase, or take away any ounce you keep outside the system. And here's the last warning. Get out of banks, take care of your own money, and buy physical silver now, or you'll miss out on the billion-dollar bets. Don't wait for news articles, Reddit threads, or viral TikToks to back up what you already know. Retail won't be able to catch up before the next leg. They control the story, the fear, and the fake money, but they can't touch the silver you have. Make sure it's yours before it's too late. That's all for the show. The stage is set, the actors are moving, And the next big move in silver could change what it means to be rich for anyone who is paying attention. The billion-dollar silver bets are already moving. Don't be the last to see them. Take charge, stack real silver, and stay ahead of the banks. Get your money before the system tries to catch you.